Ever wondered how a legacy music giant transforms into a high-margin digital empire? Today, we are breaking down the Saregama Q4 FY26 earnings results. We will explore how this legendary brand is leveraging its intellectual property engine to drive massive earnings, maximize margins, and unlock premium stock valuations. Our structural roadmap covers four major areas: the Q4 headline numbers and margins, a detailed segment breakdown separating music from the rest of the business, a comprehensive balance sheet and cash flow reality check, and finally, a deep look into Saregama's valuation, systemic risks, and long-term investment verdict. Let's see what the data actually tells us. Taking a look at the Q4 FY26 headline numbers, the company shows significant growth across every core financial metric. Revenue for the quarter reached 287.4 crore, marking a solid 19.4% increase year over year. Profits followed an even stronger upward trajectory, with reported PAT coming in at 74.1 crore, which is up 23.9% compared to the same period last year. Adjusted EBITDA spiked to 132.7 crore, indicating a strong 30.6% year-over-year growth. Most impressively, the company achieved an outstanding EBITDA margin of 46.16%, representing a substantial expansion of 421 basis points year over year.
When we look at the historical trend over the last 8 quarters, we can see a clear picture of structural margin expansion. Looking closely at the revenue and adjusted EBITDA margin chart spanning from Q1 FY25 through Q4 FY26, the blue bars representing revenue show a steady climb from around 160 crore to nearly 300 crore. Simultaneously, the green trend line representing the adjusted EBITDA margin steadily escalates from just over 10% to its peak at 46%. This top line grew sequentially by 10.4% quarter over quarter and 19.4% annually. Because operating profit growth outpaced revenue growth, it proves that Saregama's expanding catalog model requires minimal incremental cost to scale, allowing them to pull more profit from every rupee earned. To evaluate the true quality of these earnings, we need to look under the hood at the profit before tax bridge. The bridge shows an operational PBT of 105 crore, which faces a minor exception item drag of 1.55 crore due to statutory labor code adjustments, along with a tax expense of 29.27 crore, resulting in a clean reported PAT of 74.14 crore. Diluted EPS surged to 3 rupees and 86 paise, up from 3.11 year over year. This organic profit jump was heavily aided by OPEX optimization, as operating costs shrunk 41.5% year over year due to the deliberate downscaling of self-produced films. Excluding the statutory one-off item, the underlying profitability trajectory looks exceptionally strong. Where exactly is all this money coming from? Let's break down the individual business segments. Music remains the absolute engine of the company, generating 200.4 crore in revenue with a staggering 63.8% margin. Artist management is acting as the primary scaler, pulling in 42.4 crore in revenue, representing a massive 125% growth while adding 33 new artists in Q4 alone. Video represents a strategic pivot, bringing in 32.2 crore in revenue. Though revenue fell 34%, it maintained a 19.5% margin as the company trimmed high-risk films to return to profitability. On the flip side, live events acted as a drag, bringing in 12.3 crore in revenue with negative margins caused by heavy promotional costs. Saregama's massive competitive advantage lies entirely within its music IP moat. The company possesses an incredible vault containing over 180,000 active tracks that continuously earn passive income. Their digital reach is equally massive, boasting over 650 million followers across major social media channels, including YouTube, Instagram, and Facebook. This gives them immense licensing power,
leading to a 32.2% year-over-year revenue surge driven by global audio streaming platforms. Furthermore, their YouTube dominance is undeniable, pulling in 206 million subscribers and generating a mind-blowing 290 billion views in a single quarter.
The underlying story here is a deliberate and highly profitable shift from physical products to pure digital software and intellectual property. Looking at their retail hardware business, which features the well-known Caravan music player, shipments dropped to 50,000 units in Q4, down from 88,000 units year over year, leading to a 17% contraction in retail revenues. However, this is part of a calculated strategy to transition away from low-margin physical distribution networks and focus aggressively on high-margin digital licensing streams. By redirecting capital into the digital licensing pipeline, unit profitability significantly improved despite lower overall hardware sales volumes.
A quick review of the balance sheet reveals what can only be described as a fortress. Saregama is completely net debt-free, maintaining a stellar net cash position of 146.71 crore and a negligible debt-to-equity ratio of just 0.04 times. This means there is virtually no structural leverage risk to worry about. Additionally, they hold liquid reserves totaling 217.09 crore, split across cash, fixed deposits, and mutual funds, ensuring they are fully funded for strategic business deployment. Their interest coverage is also incredibly safe, as the operational PBT of 105 crore easily dwarfs their nominal 2 crore quarterly finance obligations. Now for an objective reality check on operational red flags. The key metrics flag a 48.5% PAT to cash flow from operations conversion ratio for close tracking. Looking at the FY26 numbers, the reported PAT of 206 crore versus an operating cash flow of 100 crore shows that 172 crore is currently tied up in working capital changes. However, a deeper look clears any immediate concerns about aggressive working capital management, as inventories are functionally flat at a tiny 1.3% increase, showing tightly managed Caravan units. Counterparty risk is also cleared, as their receivables are backed entirely by global tech giants like Spotify, YouTube, and Apple.
So where exactly is all this generated cash going? Saregama's capital allocation strategy is highly focused on long-term growth assets. They deployed 186 crore into organic IP creation to acquire and produce fresh music content. A massive 335 crore was directed towards strategic acquisitions, specifically targeting stakes in Finet Media, Pocket Aces, and Bonsali Productions. Finally, 86.7 crore was returned directly to shareholders as interim dividends during FY26. The clear ultimate goal here is to continuously convert liquid cash into a predictable, highly de-risked Bollywood soundtrack revenue pipeline. How does Saregama justify trading at such a premium multiple compared to standard media companies? The answer lies in their business structure, which positions them more like a recurring IP software model rather than a cyclical film production house. With a current annual PAT run rate holding steady at 206 crore and an EPS of 10.73, they carry zero inventory risk. Because their content is entirely digital, it can be instantly distributed worldwide and scaled infinitely at almost zero cost. Investors reward this structure with a premium multiple because the high operational leverage provides stable, recurring licensing income rather than hit-or-miss box office dependencies. Let's weigh the bull versus bear case for the stock. The bull catalysts are driven by a massive, multi-decade runway, given that music streaming subscription penetration in India stands at only 3%, compared to 57% in the US. They enjoy highly inelastic, recurring revenue from their vast track vault, alongside a de-risked future pipeline via the Bonsali partnership. On the bear side, potential systemic risks include near-term integration friction from their heavy FY26 cash outlays on M&A.
They also face platform concentration risks, since algorithms and pricing are controlled by external giants like YouTube and Spotify, alongside heavy cyclicality in live events touring, which saw revenues plunge 78% year-over-year.
To wrap it all up, the bottom line reveals 3 clear takeaways. First, Saregama's high-margin digital transition is officially complete, with a 421 basis point margin expansion, proving that their licensing engine is highly lucrative and operational leverage is kicking in. Second, they possess an exceptional net debt-free balance sheet that allows management to pursue aggressive, opportunistic acquisitions like Bonsali Productions and Pocket Aces without threatening solvency. Third, the long-term investment play remains strong, as any near-term working capital quirks are easily offset by massive multi-decade tailwinds pushing Indian music streaming penetration higher. What is your personal take on this media powerhouse? Do you believe Saregama fully deserves its premium IP valuation? Or are you worried about the platform concentration risks? Let me know your thoughts in the comments below. And if you found this Saregama earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.